this chart has shown that major IPOs have been followed by a market correction. Can you just explain this phenomenon?
We have never before in history had three companies with as much potential, supply of securities coming online. Now, not this year, but when those lockups expire, either in 6 or 12 months, depending on the lockup period. We're going to end up in a world with far stickier inflation, which then takes away the Fed cuts off the table. Yeah. So that's your setup for 2027.
Will a wave of tech IPOs crash markets this year? It's a scary thought, but we're going to find out. Also on the agenda, the future of Chinese tech companies and whether or not a US-Iran deal can be reached anytime soon. We're going to find out the answers to these questions and much more with our next guest, Marko Papic, Chief GeoMacro Strategist at BCA Research. This video is sponsored by Kalshi. It's the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan my QR code here. And new users who use my code LIN, L-I-N, will get $10 when you trade $10. Right now, traders are placing a 38% chance that traffic at the Strait of Hormuz will return to normal before August 1st, 2026, which is coming up. If you put $50 down on this particular trade, that may yield $126 if you turn out to be correct. Again, link down below or scan the QR code here. And by the way, we'll be discussing when traffic at the Strait of Hormuz may return to normal with Marko, so stay tuned today. Marko, good to see you. Welcome back.
Good to see you too, David.
I'd like to start with some market news now, Marko. So this morning in Taipei, Jensen Huang, CEO of NVidia, announced a new wave of AI chips. Now, in his $91 billion quarterly guidance, he gave no indication that sales will return to China. Remember that NVIDIA market share in China fell from basically 95% to effectively zero. And without any sales to China going forward, I have a two-part question. One, why is NVIDIA not selling anything to China? Or conversely, why is China not accepting sales from NVIDIA? And number two, does NVIDIA's reliance on the US and to a certain extent Taiwan make it vulnerable to geopolitical tensions between China, Taiwan, and the US? And we want to know because NVIDIA is now one of the largest stocks in the S&P 500.
Yeah, I mean, look, I think that the semiconductor supply chain is extremely vulnerable to all sorts of political and geopolitical interruptions. We saw industrial action in South Korea with Samsung, and we're seeing some of the inputs like helium that have been impaired going through Hormuz. So it's very interesting to me just how specifically fragile the entire superstructure is. Why is NVIDIA not getting any revenues from China? It is because China is trying to develop its own internal capabilities, but also because I think that we're all waiting on this new trade deal. We have 3 more meetings between Xi and Trump this year. That's a lot, 4 in 1 year for 2 leaders of China and the US. I believe that will be the first time. Maybe it's happened before once or twice, but that's quite extraordinary. So that's the first issue. And I think what you've seen over the past 2 years, particularly with the Trump administration, is that there are kind of like 2 tech lobbies when it comes to China. One is the software lobby, which has wrapped itself in the American flag. It uses national security concerns as a way to effectively argue that it should not be regulated for monopolies and oligopolies. So that's the Web 2.0 players. That's the old kind of SaaS businesses. And then you have the hardware tech lobby, which is far more amenable to selling chips to China because it actually sees China as a potential huge market. The software tech lobby doesn't. China doesn't want American software, but it does want the most advanced chips. So that's where we've seen some common ground, where the Silicon Valley, political lobbyists are not all on the same side as the Web 2.0 and some of the Magnificent Seven outside of NVIDIA have been for a very long time. Finally, I don't think that China is going to do anything on Taiwan. I think that it's patient. I don't think it wants to fall into some sort of a trap. And so I'm not too concerned about these supply chain risks, at least not for the foreseeable future.
Let's say China develops its own chips on par with TSMC, then would the US in that scenario shift away from Taiwan, give it less support, and the entire region around Taiwan and China destabilizes?
Yeah, I think it would be the sort of the other way around, David. I think, in my view, and I'm going to say this in a very glib kind of way, a very callous way, but the day that China like reintegrates with Taiwan will be the day when Taiwan is no longer relevant for the global economy. So you tell me when that happens, and I'll tell you when Taiwan will become, the province of China. So what that means is that China is not interested in crossing some sort of a red line that would, unite the West against it. I think that Beijing is quite comfortable with the current multipolar world, and that requires them to be very mature, sort of the adult in the room. The US is out there invading countries left, right, and center. China's sort of just, holding steady, putting pressure on Taiwan. Fine. I mean, it is their wayward province, as they would say. So, but it's doing so in a relatively kind of controlled fashion. If it were to do something that disrupts global supply chains for everyone from Japan to South Korea to Spain to Canada, it would risk evolving, like self-evolving, catalyzing the evolution of the world from a multipolar to a bipolar world, which I don't think China wants. Because don't forget, almost all of its final demand is actually domiciled outside of its borders because of the secular stagnation that has befallen its economy. So it doesn't have enough internal demand to generate economic growth. And so that's why I do not think that they will do anything. Now, where I do think Taiwan's relevance could wane is not so much that China becomes more developed in developing chips. It's that some of the onshoring efforts by America happen. That's why I'm not quite sure why TSMC ever, agreed to build those fabs in Arizona. Thankfully for the Taiwanese and for TSMC, it appears that the quality of some of the output in those fabs is not great. But effectively, the day that Taiwan is no longer relevant is not when China can build the chips. It's when Americans can build the chips domestically. It's at that point that Taiwan will no longer be relevant. And at that point, I can, as I said, I can foresee China taking matters into its own hands because no one's going to care.
Okay. That day is not close, is basically the assessment.
Well, I mean, from your side of the argument, when you said, when does China develop its capabilities, I've been told by people in the Silicon Valley that day is 10 to 30 years away. So China's ability to build its own chips.
What about US's ability?
The US ability, I think, is probably like 5 years away. And this is really about manufacturing, not designing them, because of course the US already designs them. So I think that but it's not just the capability, it's also like how many fabs are actually in the US actually producing this. Sure. I think it's also we're 10 years away. So I think for the next 5 to 10 years, I would say probably to err on the side of caution, 5 years. I think Taiwan is safe. Beyond those 5 years, it doesn't mean Taiwan is going to have to recalibrate its ambitions relative to the reality on the planet Earth. And the reality on planet Earth is, well, basically that Taiwan will never be an independent country, which we all kind of knew anyways.
Speaking of market risks, you had tweeted this the other day. I'll put this on the screen. It's tough to throw me off my current bullish bias, but even with the Strait of Hormuz closed, but a monster IPO might do the trick. Beware the coming IPO pollutes us. So here you have a chart showing a past IPO date. I think this is averaged, correct? Yeah, average S&P 500 performance after major IPOs. Historically, this chart has shown that major IPOs have been followed by a market correction. Can you just explain this phenomenon and what we can ultimately expect next?
So first of all, David, I do work on the sell side, so I have a PhD in chart crime. So before we go into this, let me just be very clear. This chart selects only the IPOs that did lead to the market crash. Okay. So you might say, well, this is nonsense then. Well, sure, maybe, but we'll come back to that point. It's important to understand that when IPOs do mark the top of the cycle, in those cycles when that did matter, which is not always, but in the cycles where it did, the IPO itself does not necessarily matter. What matters is effectively the float. So in other words, what matters is the lockup. So the float itself is not always relevant. And so that's a chart that really articulates the one you're showing right now even better. The IPO itself doesn't really matter because oftentimes the float is very small. So like, some of the rumors out there in the media or the SpaceX will only float 60 billion. It's not like they're going to float all trillion or 2 trillion of the IPO. That's impossible. But when the lockup expires, you do have to deal with a lot of supply. A lot of supply. Supply of what? Well, risk asset, equities. And we have never before in history had 3 companies with as much potential, supply of securities coming online. Now, not this year, but when those lockups expire, either in 6 or 12 months, depending on the lockup period. So if you're an investor thinking about more than the next 3 months, if you're thinking about the next 12 or 18 months, you have to deal with this reality that there could be potentially trillions of dollars worth of securities coming online as many of the original investors in these monstrous IPOs are released from their lockup. And that's why thinking about 2027 becomes really important. Like, what will be the supply and demand for financial assets in 27? Well, on one hand, on the demand side, I do see some headwinds. Why? Well, I think that inflation will prove itself to be far stickier, in part because the Hormuz crisis is not that existential, in part because consumers can weather $90 to $100 oil. Because of those sanguine bullish realities, we're going to end up in a world where far stickier inflation, which then takes away the Fed cuts off the table. So that's your setup for 2027. On top of that, it's highly likely that the second derivative of AI capex will be deeply negative. No, not the absolutes. No, capex will not collapse. Capex will stay high, but the change in the rate of change is going to actually be quite negative. And that's what actually matters for GDP growth. And then on top of that, you have this massive supply of equities. I think that's starting to create, potentially a pretty bearish brew for some time in early 2027.
You said you had an overall bullish bias. Why is that? What is that based on?
Well, that's based on the current setup where we are right now. I've been sort of telling my clients to fade the geopolitical risks in Hormuz, even though I did recommend on January 6th that we all buy Brent in anticipation of the war itself. So, those trades have obviously worked out. Those recommendations have worked out really well. And then at this point, the setup is that AI capex is the only thing that matters. And that, the conflict in the Middle East is likely to end in a sanguine way. So that is why I'm bullish at this particular moment. There's no real dent in the AI capex story, and trying to front run it by shorting it would be, I think, a very bad idea. That said, in 6 months, I think that we start having a much less bullish setup, particularly because I think inflation is going to prove over the next 3 months to be a lot stickier than people think. So from a tactical perspective, I don't see a real reason to short the market. But from a 6 to 12 month horizon, I'm starting to get a little worried.
A little worried because valuations are overstretched, or because demand for AI for B2B is waning?
No, so the three risks I articulated earlier. Okay. So first and foremost, I think that central banks are going to have to, take away the punch bowl in 2027. So the expectation that Kevin Warsh will come in and will cut, that's already been tested in the market. It's given us some agita throughout May. I think that is going to be the outcome. So I think we could even see a hike this year, particularly after the midterm elections. So that creates a context in 27 of global liquidity tightening. So that's the first issue. The second issue is the second derivative of AI capex. In absolute terms, AI capex is not going to come down. We will continue to see an increase. The problem is that we've had 200 billion annual AI capex become 400 billion, become 800 billion, become a trillion and 100. Does anything sound bearish in what I just said? Well, it should. It's extremely bearish. GDP growth does not depend on absolute numbers. If you have 7% budget deficit every year, are you stimulating the economy? Many investors, I would say most investors, think the answer is yes, but it's not. If you just have 7% deficit every year, you're not stimulating the economy because the rate of change of that variable is zero. Similarly, with AI capex, we're going to have extraordinarily negative second derivative. And that's what matters for GDP growth. And so that's my second reason to be cautious for 2027. And then finally, it's this issue of IPOs and what happens when the lockups end. Now, that's not imminent. Neither one of these three items is imminent. In fact, most of your viewers, their eyes probably glazed over as they tried to articulate the mathematical concept like the second derivative. It's like, okay, bro, like whatever, which is fine. That's cool. That's why, I want to stay bullish and I want to stay tactically positive on risk assets. But I do think that by the end of the year, those three are going to start, showing up on people's radar screen.
Okay. U.S.-Iran deal. This is something you follow very closely. This is from Kalshi. It's a prediction market. So traders are predicting 42% chance before December. So about, a coin toss before the end of the year. I wonder what the oil market is pricing in. Is roughly corroborating the same kind of probability here at $91 a barrel.
Yeah, so the problem with that question is that nobody should care about a nuclear deal.
Okay, interesting.
Yeah, so I think that's if you ask me, Marco, when would you buy this? I would say I don't care. I don't spend my time thinking about it at all. And there's two reasons for that. First of all, we've been operating in a world where ships do transit through the Strait of Hormuz. So on May 29th, Bloomberg had this interesting article that said that basically a quarter of all oil-laden tankers got through the strait. Somehow magically, they ended up on the other side. Now, yes, our ships coming in to pick up crude. Well, if a quarter of all tankers got through the Hormuz Strait and we don't have that in our records, then I'm pretty sure some are going in as well. And so we have to stop pretending like these twin blockades are a 1 or a 0. They are a permeable membrane. So it is in both Iran and US interest not to cause a calamitous recession. And therefore, they are letting enough crude go through, adjusted for the global inventory levels. As those inventory levels are drawn, they can calibrate the permeability of the membrane so that more crude goes through. If they wanted to have a recession, then they could just bomb each other further in significant ways. Iran could actually attack Qatari LNG, take 30% of natural gas offline. They proved on March 18th that they're capable of doing that, and the US could do the same. So that's why the nuclear deal doesn't matter. What matters is, are ships going through Hormuz? They are. They seem to be intelligently calibrated in terms of how many are going through. And then the second point is, what if we just get a memorandum of understanding, as they're actually negotiating right now, that does not deal with nuclear issues, punts them into the next year, and actually opens the Strait of Hormuz. And so that's why, that particular question is maybe not that correlated with markets. I think the market, to criticize my view, would be to say that there's no alpha in my view, because it's clearly already priced in by the market. The market clearly agrees with me, which is why it's up, despite there not being a deal.
The $91 a barrel oil price, then, is it assuming that the oil flow through the Strait of Hormuz will return to normal? Basically, $91, is that pre or post Strait of Hormuz closure?
So I think $91 is, unfortunately, there's no silver bullet, David. I would say that it's all sort of you're making a goulash here, with a lot of spices. You're not making a melted cheese sandwich. And the reason I say that is because it's all, the price of crude reflects how much inventory there is in the world, which, by the way, we're constantly being surprised by. Every single expert at crude, people who count barrels for a living, they've all been proven incorrect in this crisis, because we keep finding crude barrels in the cushions of our proverbial couches across the world. So that's one thing that the oil prices are realizing. The second is the oil prices factoring the reality that some vessels are going through. And remember, one vessel is 2 million barrels a day. And then finally, it's the discharge here. So I would say that if the Strait of Hormuz opens, by September 1st, which is where 44% probability is, I think that we're probably going to be okay. The problem is that it depends. Like when we say return to normal, well, we don't need Strait of Hormuz traffic to ever return to normal, and oil could be at $20. Mm-hmm. Let me explain. 20 million barrels a day transit the Strait of Hormuz, right? Not needed. We have 6 million barrels a day that can go through 2 different pipelines.
That's right.
So what we really need is just 14 million barrels. So that probability could be 0, and oil could be back at $60. Mm-hmm. So that's why, again, complicated situation, but one that I would say the market has gotten correct, largely because it assumes that inventories will hold out long enough for us to get to a deal between Iran and the US, which is not the final deal. It's not the deal, but it's a deal that gets us to somewhere where 10 million barrels of crude transit straits. By the way, that's 5 VLCCs. That's 5 VLCCs. If we get to that by end of August, I think the economy will be fine. That's what I'm looking for. I would like somewhere between 4 and 5 a day by the end of August, and I think that we will be okay at that point. At that point, you just need demand elasticity and inventory to take care of 5 million barrels, and 6 million barrels go through pipelines, and you've got the 20 million that you needed.
By the way, on the pipelines, how reliable would these pipelines be for not just the West, but Asia, who needs oil coming out of the GCC? So I know the UAE is building a pipeline. They said they're, 40, 50% done, might be done by next year. What's stopping them or anybody else from also choke pointing, quote unquote, these pipelines at will?
So UAE currently has 1.8 million barrel pipeline to Fujairah port, which is active. And then Saudi Arabia can get, about 7 million barrels of crude across the desert, although it was already doing 3. So together, they're already taking 6 million of crude that was going to be on ships to go through pipelines. How likely you're asking? Well, look, Saudi Arabia and UAE don't have any interest in choke pointing this crude. They have a great relationship with China. And one of the reasons that I think Iran has not taken this conflict to a level that it could have, where they're permanently destroying some of this infrastructure, is because China has very politely asked him not to do that. So, I think the risk of these pipelines being affected is very low. But I do think that if Israel and Iran restart some of the regime change talk, if they restart some of the existential risk to the Islamic Republic activity, like killing the next supreme leader or wanton bombing of their infrastructure, then at that point, maybe Iran will attack these pipelines.
Finally, we have a few minutes left. I want to talk about the future of a potential multipolar world. Now, you mentioned that you pointed out most institutional investors are probably only roughly 2% invested in China, the second largest economy, which may one day be the largest economy in the world, and 20% of global GDP currently. I wonder if the proportion of U.S. assets in an institutional portfolio based in the U.S. should be less, especially going forward.
Yeah, so that's actually one of my core secular theses. It's that there's multipolarity everywhere. We're seeing evidence of it absolutely everywhere, from what brands of basketball shoes you might buy to play in, to how many international players are playing in the NBA, to I keep thinking of basketball analogies. You can see what my mind is on, to all sorts of things, EVs, models of cars. We're seeing multipolar distribution of power across business, across commerce, technology. The only place where we're not actually seeing it is in the portfolios of institutional investors, David. So yes, I do think that on the margin, the attractiveness of U.S. assets is going to decline over the next 5 to 6, 7, 8 years. But it's not because America is losing. Just to be clear, this isn't a sell America trade. This is more like buy something other than tech trade. So we're in a high nominal GDP growth environment. We're building a lot of new things. That's what's happening. You want to own some industrials, you want to own some commodities. It doesn't mean that you want to necessarily not own America. And by the way, I would remind investors that from 2002 to 2011, we were in that kind of a world. And the United States of America wasn't like in a bad place during that time. Yeah, there was a real estate crisis, obviously, although that was a global recession, not just America's fault. And in fact, America invented, as I'm holding up my iPhone here, almost absolutely everything we're excited about. So from 2002 to basically the GFC, you definitely did not want to own America relative to the rest of the world. You definitely did not want to own USD denominated assets. But it's not like the United States of America lost power or lost entrepreneurial acumen or lost the ability to innovate and so on. So that's just something to keep in mind. When people say you should diversify globally, it's not because America is somehow losing. It's that in people's portfolios, they're already up to their necks in American assets. And there's some really cool things going on around the rest of the world.
Well, final question then. If you were a global investor, such that you were diversified globally, and you had to pick an industry or a sector within the U.S. to invest in, well, could you look at it this way, that the U.S. is better than other countries at certain things, and so we should invest in those certain things that represent U.S. exceptionalism relative to other countries? In other words, comparative advantage of the U.S., what would those industries be?
I would pick three, if I can pick three.
Sure.
I would pick energy, actually. Energy is it's not a big component of the American equity index, but I do think American energy companies are very competitive and they know what they're doing, and they have, almost no exposure to geopolitical risk because they're kind of drilling domestically. The second thing is privates. I do think investors need to start thinking of privates more globally. You shouldn't just have, your venture portfolio just be in Silicon Valley. You should start thinking about it in Europe, in Southeast Asia, Japan. The thing is, that is where America really is very good. It's very good starting companies, particularly in the tech space. And I do think that when you look at some of the venture, particularly tech valuations, they've really collapsed. And so I do think there's value there. And then finally, America is the best at tech. The problem is that, tech itself, I don't think is going to outperform the other sectors over the next 5 years. And that's the irony, because we're in the middle of the AI supercycle. But tech is not necessarily doing great. What's doing great is actually either the CapEx plays that enable AI to be built out, or all the other sectors where using AI will boost productivity and margins, like healthcare or finance. Nonetheless, you ask me the question, what is America best at? And it's clear that America is best at tech in the world. I don't think that will change.
All right, Marko, thank you very much. Where can we follow your work?
On Twitter, on X, Geo_Papic. I also have a podcast that might be interesting to your viewers, Geopolitical Cousins. It's really more comedy than it is finance, by the way. It's just comedy and geopolitics. I don't do any market implications. And then, of course, the firm I work at is BCA. You can go to bcaresearch.com and follow us there too.
We'll put the links down below if you want a good combo of comedy and geopolitics. Please listen to Marko's podcast. Thank you so much, Marko. We'll see you again soon. Take care for now.
Absolutely. Bye-bye.
Thanks for watching. Don't forget to like and subscribe. Follow Marko in the links down below. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new users who use my code can get $10 when you trade $10. Link down below or scan the QR code here.